Welcome to Talk Tickers. We're here to cut through the noise of earnings calls and give you the insights that matter. And today, we're taking a deep dive into Henry Schein's Q2 2025 results.
Right.
This report definitely sent some ripples through the market, and it really needs a close look for anyone tracking healthcare distribution.
Indeed. Yeah, the top line numbers, well, they offered a bit of relief, maybe even a slight beat. But it was really the bottom line that grabbed the market's attention. And not exactly in a good way.
Okay.
So we'll unpack that immediate reaction, dig into the pressures Henry Schein's facing, and then look at management's, well, pretty confident outlook for the second half.
A tale of two halves, then.
Kind of, yeah. And the market's trying to figure out which half is real.
Okay, so let's start with the headline numbers. Q2 2025. Henry Schein reported non-GAAP EPS of $1.10.
Right.
Now, that unfortunately missed the analyst consensus of $1.19, a noticeable miss, about 9 cents.
Yeah, that's small.
But on revenue, they actually brought in $3.24 billion.
Which was slightly ahead of consensus.
Exactly, and showed solid year-over-year growth, 3.3%.
And that growth was pretty broad-based, wasn't it?
It was. Internal growth was 1.9%. Acquisitions added another 0.8%, and even FX helped a bit, 0.6%.
Okay.
Adjusted EBITDA, though, that came in at $256 million.
Down from $268 million last year. So that's where you see the pressure point. And what's really fascinating here, I think, is the market's reaction. It was swift and pretty negative.
Despite the revenue beat.
Despite the revenue beat, which usually gives a bit of a buffer. But the EPS miss just weighed so heavily.
So what did we see? Shares down about 5% pre-market?
Yeah, and then it got worse. A significant 7 to 9% drop intraday. And on heavy volume, too.
Okay.
Which really signals a clear, risk-off feeling from investors.
And then that's interesting because the company was buying back shares, right?
Exactly. That's the tension. They completed $259 million in buybacks in the quarter. Some of that was an accelerated plan after KKR made their big investment.
So the market just looked past the buybacks, past the KKR validation almost.
It seems like it. They zeroed in on the core operational profitability, suggesting maybe some deeper skepticism about the short-term earnings picture.
Okay, let's dig into that core profitability then. Specifically, the margin pressure in the U.S. dental business. Management flagged two things, right? Lower glove pricing, which, okay, we've seen that elsewhere.
Yeah, industry-wide.
And then these time-limited targeted sales initiatives. What was the thinking there? Was it just a one-off thing?
Well, that's the million-dollar question, isn't it? The company said they launched these programs to sort of re-engage customers who'd maybe cut back purchases over the last 18 months or so.
Trying to fill a leaky bucket, basically.
Pretty much, yeah. Trying to win back some loyalty. Now, these promotions, they definitely compress gross margins temporarily. But management insists it was strategic. And the good news they reported, or at least the positive spin, was strong merchandise sales momentum carrying into July, which they say indicates a return to more normal promotion levels. So the hope is the margin hit stabilizes and the re-engagement worked, not necessarily a sign of continuous discounting ahead.
So recovering lost ground, not setting a new baseline for lower prices.
That seems to be the narrative they're pushing.
And what about equipment? That also hit a snag, you said, particularly in May.
Yeah, equipment sales had a bit of a hiccup. Management blamed it on, general economic uncertainty, maybe some tariff worries floating around.
Big ticket items often pause first when things feel shaky.
Absolutely. They're a good indicator. But the positive sign here is that order intake apparently normalized pretty quickly by the end of the quarter.
Okay.
And the equipment backlog actually recovered. It just means some installations got pushed into Q3.
So timing rather than lost sales.
That supports management's view, yes. That the softness was, transitory, not some fundamental structural problem. They expect equipment sales to bounce back in the second half.
Any leading indicators on that?
Actually, yes. They mentioned new office design projects. Those were down double digits only in May.
Just May.
Just May. Every other month in the quarter saw double-digit growth year over year.
Wow, okay. That's a pretty compelling rebound pattern then.
It suggests the underlying demand is still there, despite those temporary jitters.
That recovery is good news. But zooming out, what's the vibe in the broader U.S. dental market? How are dentists actually adapting?
It's a good question. Management's view is that dentists are continuing to invest, especially in tech.
Things like digital equipment, software.
Exactly. things to boost productivity, efficiency. So there's still a long-term trend towards upgrading, even with short-term worries.
And patient traffic.
Seems relatively stable globally, which is key for underlying demand, but staffing is still a headache.
Hygienists, office support.
Yeah, those roles. It's apparently better than a year ago, but still a bottleneck, which, actually makes Henry Schein's tech solutions potentially more valuable.
Interesting angle. And are dentists changing what they buy?
They are. There's a noticeable shift towards Henry Schein's own brands.
Higher margins for Schein there.
Generally, yes. And also towards products from manufacturers offering, let's say, moderate pricing, partly driven by those tariff concerns again. So definitely a focus on value and cost efficiency. We see that everywhere.
So, okay, we've got these margin pressures, market dynamics. How is Henry Schein planning to fundamentally improve things? This brings us to KKR, right? And the restructuring.
Exactly. Two big strategic moves. Let's start with KKR.
$250 million investment, 12% stake, 2 board seats. That's significant. What's the real impact here?
Well, it's not just the money, though. That helps. It's KKR's operational expertise. They bring in KKR Capstone, their operating advisors.
Known for getting hands-on.
Very hands-on. This partnership is core to Henry Schein's multi-year plan. 2 main goals here.
Okay.
First, boost those distribution gross margins by pushing more own brand sales.
Which we just said dentists are leaning towards anyway.
Right. And second, drive company-wide efficiencies. This is kind of an expansion of their existing Bold Plus One strategy.
Remind us quickly what Bold D+1 is.
Sure. It stands for business model optimization, operational efficiency, leveraging data, digital solutions, plus their core value delivery.
Got it.
So KKR is helping accelerate all of that.
Okay.
But don't expect results overnight. They're saying tangible benefits towards early 2026.
A longer-term play then.
Definitely.
Yeah.
But a powerful signal of structural change.
And alongside KKR, there's this big restructuring plan. What are the costs and what's the payoff investors should look for?
So they booked $23 million in restructuring charges in Q2. Mostly severance, seems like.
Okay, near-term pain.
For hopefully long-term gain. They expect these actions to deliver over $100 million in annual run rate savings by the end of 2025.
$100 million, that's substantial.
It's huge and absolutely crucial for boosting profitability long-term. This isn't just minor tweaks. It feels like a real strategic re-engineering of their cost base.
So these savings are key to bridging the gap from those current margin pressures to future growth.
Exactly. Foundational stuff.
Now, while distribution faced those headwinds and is getting this overhaul, other parts of the business actually did quite well.
Right. Let's talk about the Global Specialty Products Group and the Global Technology Group. These are important for the future mix.
Tell us about specialty products first.
Saw solid growth, 4.2%. And momentum seems to be accelerating in high-value spots like implants, biomaterials, endoconsumables.
High value, meaning higher margin, too.
Generally, yes. They saw double-digit growth in their value implant lines like SIN and Biotech. Even their premium brand, BioHorizons Camlog, grew low single digits.
Okay.
And profits got a boost from consolidating manufacturing facilities. So efficiency gains there, too. Even orthodontics, which has been tough, saw its decline slow down.
So specialty products looking pretty healthy.
It seems to be a key growth engine.
And then there's the Global Technology Group. That really seemed like a standout. Sales up 7.4% acceleration.
Yeah, that's a really crucial area for future margin expansion. It's really firing.
What's driving it? Practice management software.
Primarily, yes. Especially their cloud platforms, Dentrix Ascend in North America, Dentally internationally, plus their revenue cycle management tools.
Cloud is key here.
Absolutely. They reported a 20% jump year over year in cloud customers. Over 10,000 subscribers now.
That's sticky recurring revenue.
Exactly. That's the beauty of the model. It builds a reliable base.
Are there risks here? Competition, cost of migration.
Well, competition always exists in tech. But Henry Schein has that huge installed base to migrate. The investment costs seem factored in, and the long-term payoff from recurring revenue, likely outweighs that.
And this is becoming a bigger part of the profit picture.
Significantly. These high-growth, high-margin tech and specialty businesses together made up over 45% of non-GAAP operating income in Q2.
Getting close to their goal of over 50%.
Right. This whole digitalization push, scaling these higher margin parts, it's central to that bold D+1 vision. It's how they plan to offset the distribution pressure and really change the profit profile.
Okay, one last big piece of news from the call. Stanley Bergman retiring as CEO at year-end. He'll stay as chairman, but still after 45 years. That's huge.
It's a massive transition, raises obvious questions about continuity, especially with all these big changes happening.
He basically built the company into what it is today.
He absolutely did. From a small mail order firm to a global giant. He did express confidence in the current team, though.
Naming names.
Yeah, specifically Andrea Albertini, who runs global distribution, and Tom Popp, heading up global specialty. He flagged them as key leaders already driving the strategy.
And the search for a successor.
They've hired a recruiting firm, looking both inside and outside the company.
Standard practice for a company this size.
It is. Best practice, really. Ensures a thorough search, signals a smooth handover, hopefully, just as these KKR initiatives start showing results. The market will definitely watch who gets the job.
So let's tie it all together. What does this mean for you, the investor, looking at Henry Schein right now? The market clearly hammered the stock on the Q2 miss.
No question. Very negative reaction to the EPS and margins.
But management is sticking to their full-year guidance.
They are. And they're emphasizing very strongly that earnings will be heavily weighted to the second half. Q4, potentially even stronger than Q3.
So a big disconnect between the market's current view and the company's story.
A very clear divergence. The company is betting big on this H2 turnaround, fueled by the restructuring and the KKR partnership kicking in. So if you're an investor, you're now watching for tangible proof points, right?
Milestones.
Exactly. Need to see real progress on those margin initiatives. Need to see owned brand penetration climbing. Equipment demand needs to show that sustained rebound.
And more updates on KKR.
Definitely. Concrete updates, with results expected, again, starting early 2026. The Q3 call is going to be critical.
Checking progress on restructuring savings, that H2 weighting.
Historically, Henry Schein has often lagged the broader market and even the healthcare sector.
Right.
So if they can actually deliver credible cost savings and improve that business mix significantly, well, the market might reward that disproportionately. There could be real upside if they bridge that gap between skepticism and their optimistic plan.
Okay, that brings us to our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea, hedge fund style. Given everything we've discussed, the Q2 reaction, the H2 hopes, KKR, restructuring, what's the play?
All right, here's one for the contrarians out there. Someone who believes the market's overreacting short-term and missing the longer-term picture.
Okay, let's hear it.
We'd think about an aggressive, long-dated bullish options strategy.
Ooh, okay. Details.
Specifically, buying out-of-the-money call options on Henry Schein. Targeting a strike price well above where the stock is now, maybe something like $80 or $85.
And the timing.
Needs to be long dated. Think Q1 or even Q2 of 2026 expiration.
Why so far out?
Because this isn't just betting on the H2 rebound happening, it's betting on the market starting to aggressively price in the real impact of those KKR efficiencies and the full $100 million plus in restructuring savings.
Which won't fully hit the numbers until later.
Exactly. Those are expected to yield results well into 2026. So it's a bet that the long-term story completely swamps the short-term worries, leading to a significant stock re-rating.
The options give you the leverage, the outrageous potential.
Right. And the strategic shifts, the restructuring, the KKR involvement that provides the plausible foundation for why that re-rating could actually happen. It's a bet on fundamental change overcoming skepticism.
All right, that wraps up our deep dive on Henry Schein's Q2 2025 earnings call. A really mixed quarter, wasn't it?
Definitely. Top line beat, but that EPS miss really hurt sentiment. Market reaction was cautious, to say the least.
But management, still optimistic, pointing to KKR, the big restructuring, strength in tech and specialty, all building towards that big second half.
The huge question for you, the listener, is, can they actually pull it off? Can they hit those aggressive H2 targets? Can they unlock that long-term value with KKR, especially under new leadership?
Yeah, what will next year's earnings really look like once these plans fully kick in? Could it set a whole new baseline for growth?
And will it finally change the market's perception of the company's profitability? That's what everyone's waiting to see.
As always, remember, this is purely for educational purposes. It should definitely not be taken as financial advice.
Please do your own research. Consult with a professional.
Thanks for joining us on Talk Tickers. If you have questions or other calls you want us to look at, let us know.
We'll be back soon with another deep dive.